All right, great. Well, welcome everybody. Today is Tuesday, March 18th, and this is our first all-client Zoom of this year. And I decided to put it on because we are in the middle of what I'm pretty sure is going to be our third stock market correction of this bear market. And I'm really excited because I'm heading out for vacation for 10 days on Friday, and I wanted to get all those questions answered before I left for vacation, so that you guys would have my thoughts on kind of what's going on right now and what I foresee will probably happen throughout the rest of this year. As I said, please feel free to unmute yourselves and ask questions during the presentation. And I will also have time for questions at the end of the presentation today. All right, so let's get into it. So as I said, this is probably our third stock market correction of this bull market. The bull market is now 2.5 years old. It started in October of 2022, following a 10-month correction or a 10-month bear market, a 10-month bear market in 2022. That went from about January of 2022 and ended in October of 2022. So, we're this is still a relatively young bull market. This is sort of what we've experienced so far in this bull market. This is a chart of the S&P 500 from the start of the bull market. And you can see I've notated the very first correction that we had, which was in the summer of 2023. It was a very kind of classic correction. The stock market dropped by about 12%. It took about 4 to 5 months for the stock market to hit new all-time highs. That is a very normal correction. Now, the second correction that we had, actually, it probably doesn't even qualify as a real correction because it happened very quickly. But I can tell you from my conversations with all of you, it sure felt like a correction when it happened. And this was in the summer of 2024. It was a really fast correction. The market sort of in just a couple weeks time dropped by about 10%, but then very, very quickly recovered. And so we were over that second correction pretty darn fast. And now we're probably in the third correction of this bull market so far, where we've seen the S&P 500 drop about 10%, which is kind of the classical definition of a correction. And if this drop lasts, at least a few months, it's actually at least 60 days, then it'll be qualified as an official correction. But again, it's more about how it feels that matters than some technical definition. And I can tell from talking with most of you, it feels like the third correction of this bull market. All right, so kind of what to expect of a bull market in general, right? Bull markets on average will run about 5 to 7 years. Okay, so if we're 2.5 years into this one, on average, we can expect another 3 to 5 years of a bull market run. During a bull market, we experience typically higher than average returns in our portfolio, certainly higher than average returns in the stock market. Okay. Along the way, during that 5 to 7 year bull market, it is very normal to have one of these corrections about every 12 to 18 months on average. We never really know ahead of time what's going to cause the corrections, right? It could be a lot of different things, but on average, they tend to pop up every 12 to 18 months. All right. And right now, okay, we can sort of expect a lot of volatility in this bull market because there's some economic uncertainty going on, right? Which we'll talk about in more detail. All right. So again, bull markets on average, just understanding typical bull markets. Okay. In a typical bull market, we can expect something like a doubling to tripling of the value of the stock market. Okay, in a typical bull market from start to finish, we would see the stock market anywhere from double to triple in value. All right. Now, going back to 2002 to 2007, kind of post dot-com bubble bursting. Okay, that bull market that went from 2002 to 2007 saw about a doubling in the value of the US stock market. All right. The bull market after that, after the financial crisis in 2008, that bull market that went from 2009 to 2020, we saw about a 5 times growth in the value of the US stock market. Okay, so huge growth in the stock market during that very unusually long bull market. All right. Now, post-COVID, right, coming out of COVID, we had a very fast, very aggressive bull market where we saw another doubling in the size of the US stock market from start to finish of that bull market. And then so far in this bull market, starting in October of 2022 to date, we've seen about a 60% growth in the value of the US stock market. Okay, about 60%, so like 1.6 times, which means we still probably have anywhere from another 40% to 140% to go before the end of this bull market. Again, probably, right? There's plenty of things to worry about. There's always lots of things to worry about. But if we just sort of play the averages, this is what we would more or less expect. Okay. Now, this chart again demonstrates average sort of growth in bull markets, but goes back much further, right? This is showing bull markets going all the way back to 1928. All right. And you can see kind of cumulative, this is actually a 5-year average growth is what this is charting. But you can, the size of the blue spikes gives you an idea about how robust, how much growth we saw in the US stock market during those decades of time where we had bull market growth. Okay. And you can see the big standout one is in the 90s, right? Where we had kind of the beginnings of the tech bubble. All right. But then you can see, after that huge, after that huge kind of 90s growth, we had some pretty normal growth in the 2000s. We had higher than normal growth coming out of the Great Recession. We had kind of a nice little bull market coming out of COVID. And then here's the bull market we've had so far. Just this tiny little bitty mountain, right? And so I show you this chart just to again reinforce this is still a baby of a bull market. This is a very early bull market. We still probably have a lot of room to grow. But again, along the way, corrections happen. Okay, so why do corrections happen? What are these corrections in the stock market that pop up every 12 to 18 months that most people say are healthy, right? It's a healthy correction, right? Well, it doesn't feel very healthy when you're on the receiving end, right? And you're watching your portfolio value drop, but it helps a little more to understand kind of the why behind it, all right? So graphically speaking, okay, these are the 3 different types of downward movements in the stock market that we see along the way. We see corrections, which are temporary drops. Okay, it's a temporary drop of 10% or more that lasts for 60 days or more. All right. Sometimes, though, corrections lead into bear markets, which are typically, but not always, associated with recessions. Okay. A recession is a shrinking of economic activity. Okay, specifically, if we're talking about a US recession, a shrinking of economic activity in the US. Most often people talk about GDP, right? GDP is shrinking, right? Okay, and that's associated with a recession. Although bear markets aren't always associated with recessions. A perfect example was the last bear market we had. In 2022, we had a 10-month bear market that was not associated with an economic slowdown. In that case, it was caused by essentially the Fed dramatically increasing interest rates to fend off high inflation, okay, which of course certainly had economic ramifications, but it wasn't a classic bear market because most often we expect to see bear markets associated with recessions, all right, but not always, all right. And then, of course, there are crashes. Okay, crashes usually happen when something involved in our economic system breaks, right? Breaks in a real way to which entrepreneurs can no longer create profits, right? And we're going to dive into exactly that kind of economic profit-making system now. All right, so at the heart of economic growth is the entrepreneur, right? They're the ones driving economic activity, right? So entrepreneurs, their job is to bring together the factors of production, which are capital, which is money, resources, which is either raw materials or land or, some place that business can be done, and then workers. And they do that to create profits. Okay. So recessions happen when the entrepreneur, for some reason, is no longer effectively bringing together those three factors of production to create profits. When that happens, we have recessions. Okay. Now, in this country, as in all countries that use any economic system, okay, there's some sort of link bringing together and governing how the entrepreneur brings together these three factors of production. In this country, it's democracy and capitalism, right? But that's not the same all around the world. It's just in this country, we use democracy and capitalism to bring together the entrepreneur and those three factors of production. And that's been very, very successful at creating profits, right? As a matter of fact, it's probably the most successful system at creating profits, right? Okay. Um, and there's lots of things that go into that triangle, right? That triangle makes up a lot of different things. But today we're just going to focus on three things that make up that triangle that govern how entrepreneurs bring together the factors of production. And we're going to focus on monetary policy, which is the Fed. We're going to focus on taxes and trade, and then we're going to focus on laws and regulations, okay? Because those are the things most impacting this correction and most in the news about our economic system right now. All right. So again, we've got the entrepreneur, we've got, them bringing together capital, them bringing together labor, and then doing it either in a place of business or using raw materials to make stuff, okay? So most of us or most people participate in this economic system either by working a job, so they're one of the laborers in that economic system, or they own a business and they're the entrepreneur at the center of this system. Okay. My clients also participate in this system by providing capital to these entrepreneurs through the stocks and the bonds that you own inside of your portfolio. All right. You also, inside your portfolio, okay, own commercial real estate and commodities. Okay. Here I'm gonna move my little picture out of the way so it's easier to see. Okay. So those are the two ways in which everybody on this call, all of my clients, whether you're working a job or owning a business, you are participating in this economic system through the stocks and bonds that you own in your portfolio, providing capital to the entrepreneurs, and through the commercial real estate and the commodities that you own in your portfolio, okay, which provide some of the inputs for entrepreneurs to make profits. And as those profits are made, you reap the benefit of those profits through your stock and bond ownership or through your commercial real estate and commodities ownership. All right. So as long as that system is functioning, right, profits will be made and your portfolio will grow. All right. But every now and then, it looks like there may be a problem with some part of this system. And that's when corrections happen. Okay. Corrections happen when there's a worry emerges. Okay. Almost out of nowhere that, ooh, maybe this system isn't working exactly the way it's supposed to. Now, I gave you the heads up that this correction would happen. Okay. I didn't know it was going to happen literally like 2 weeks after I sent this email. But in my email, dated February 28th, I said, okay, whether you love or hate the changes happening around the country right now, we all need to understand that there is a heightened level of anxiety among both consumers and business owners. And that's this uncertainty, this anxiety is due to this cloud of uncertainty over large parts of our economic system. It's not that anything is broken, it's not. It's just there's a cloud of uncertainty about exactly how all those factors of production are going to come together and what the rules and regulations and supply chains governing how all those factors go together. Okay. And that cloud of uncertainty combined with a higher than normal level of anxiety is going to create a lot of volatility and probably a correction. Okay. And I said at some point this year, we're very likely to experience a correction. So don't panic. So I know none of you guys are panicking because I told you it was coming and I told you not to panic, right? But this call is just go over again the whys and the hows. All right. So So this is what we've got right now, right? We've got our economic system with our capital and our workers and our resources and our entrepreneur in the middle. Okay. And so why is the correction happening? Well, the correction is happening because our entrepreneur in the middle is not sure about what investments he or she should be making in the future growth of the business. Okay. And the reason that entrepreneur is not sure is because they're facing a lot of questions. Okay. Some of those questions they're facing are around taxes and trade, right? How long will this trade war that we're in last? Will the tariffs be on for a month or two, or will they be on for a year or two? Okay. The uncertainty around that creates a little bit of a cloud of uncertainty, right? There's uncertainty about monetary policy. Big questions there. When will the Fed lower interest rates? Will we see inflation begin to surge? There's questions about laws and regulations. What will the impact of deregulation be, right? What will the rules of hiring employees be like? What will the relationship be like with unions and employment laws going forward? Okay. Those big questions combined with a whole lot of other things going on, like a war in Ukraine, changes in government spending, changes in consumer confidence, using more oil resources domestically, a war in Gaza, and government layoffs create a really big, thick fog that these entrepreneurs are surrounded by. Okay. And as long as that fog persists, entrepreneurs are going to continue to make the decision, you know what? I'll just put off some big investment decisions for a little bit. I won't hire that extra employee right now. I'll push that off maybe a little bit until I get some of these questions answered. Or I'll wait to expand my office space, or wait to buy another building or to build another assembly line, okay, until I get some of these questions answered, right? So that's the impact of kind of this fog that I'm talking about, is that it raises all of it prevents the entrepreneur from making future investment decisions. All right. But we are not the only economy out there, right? There are other economies out there. And so let's talk about those. All right, this little economic system that I'm talking about exists in the US and we're really good at it. Okay. And you have exposure to that economic system through your US large cap investment in your portfolio. Those are stocks, US mid and small cap stocks, US bonds, and US REITs. Okay. Real estate, commercial real estate. Okay. But we're not the only game in town. There's an economic system just like this operating in Europe. There's an economic system just like this operating in Asia. There's economic systems all over the world in what we call emerging market economies. And you have significant exposure to all these other economies happening outside of the US through your European large cap stock investment, your Pacific large cap stock investment, international small cap, emerging markets, international bonds, international REITs, all of those other colors in the pie chart, right? They all create opportunities for growth. Okay. So let's dive into a little bit about what those other opportunities for growth have been doing. Okay. All right. We are right now seeing what I believe is going to be a big shift in investments, investment performance. And this shift is going to be a shift kind of away from growth oriented investments, more towards what is traditionally called value investments. Okay. So examples of growth and speculative investments. All right. These growth and speculative investments have been the best performing investment in the entire world since about 2020. Growth stocks have been driving portfolio performance. Okay. Think about like the NASDAQ, right? Think about Nvidia and Apple, right? Those high flyers here in the US. Those are the growth speculative investments, all right? We can even throw in things like cryptocurrency, right? As a speculative investment that's had huge growth, right? Those have had their day. They've been having their moment in the sun for quite some time now. The price of those stocks compared to their profits today were skyrocketing. Okay, this is called a price to earnings ratio. We were seeing something like 40 to 50 times, the what you would pay for the price of that stock compared to the profit that those companies were generating. That's a very, very, very high multiple. Okay. Those multiples were driven by hyper optimism, right? The growth in these companies was going to continue to skyrocket forever, right? And again, we're talking about mainly very large US tech companies were benefiting from this sort of trend of preferring growth and speculative investments, right? Comparing that with value investments and international investments, which have had positive returns during this period, but nothing like what the US large growth companies had been experiencing. Okay. So positive returns, but more single digit type returns. Okay. Those stock prices trading at somewhere closer to 8 to 15 times profit. Okay. These are classic kind of Warren Buffett style buys, right? The companies that fit into this sort of description. Mostly US large cap value stocks, US mid and small cap stocks, but also very much European and Pacific Rim company stocks. All right. So this shift that I'm talking about, we don't know that it's happening, okay? But it is my theory that I believe we're starting to see this shift in preference, which will be a shift in long-term performance from the growth speculative investments more to the value in international investments. Okay, and I'm going to demonstrate that using two different charts here. This chart shows you the outperformance of US stocks on top of the graph compared to periods in time where we had outperformance of non-US stocks, international stocks, stocks in Europe, stocks in Asia. And what we've seen going back about 50 years is that there does seem to be a cyclicality to that preference for US stocks outperforming versus that preference for international stocks outperforming. And you can see we've been in a very, very, very good long period for US stocks. The last 14 to 15 years, the market has been preferring US stocks, and we've been seeing significant growth out of US stocks. And it's not for no reason at all. It's because the US economy has been way outpacing most other industrialized countries outside the US. But again, there does seem to be a cyclicality to this. And I believe we're starting to see the beginnings of a shift in that preference, a shift in that cycle from US dominating performance to non-US countries being a source of more performance than US. And again, this does not mean US is down. US can absolutely still deliver positive returns. And I believe the US stock market will still deliver positive returns. But I believe there will be more returns to be had by maintaining our very, very healthy international allocation. Okay. Same thing with growth stocks compared to value stocks. All right. Again, there is a historical record that value stocks outperform growth stocks. Okay. And this goes all the way back to 1936. Okay. This chart, again, when the line is above, okay, the horizontal axis, value stocks have outperformed growth stocks. When the chart is below the horizontal axis, growth stocks have outperformed value stocks. So what we've been seeing is a historical sort of aberration, right? Something very unusual, where the last 10 years, we've seen growth stocks significantly outperform value stocks. I think that is flipping back. I think we're again going to see a period of time, not where growth stocks are negative, but where value stocks are delivering higher performance overall than growth stocks. Okay. And in your portfolio, all right, we maintain and we have maintained for years very, very high value allocations, and very, very high international allocations. Okay. Matter of fact, our international and our value allocation is about 2 to 3 times what our peers have been doing the last couple years in international and in value. And we see that in the performance of the portfolio in this bull market. All right. So depending on what model portfolio you have with us, you guys are probably, if you're in the accumulation phase of life, you're probably in our growth portfolio, which is listed at the top there. If you're sort of an early retiree or coming up on retirement, we probably have you in our growth and income portfolio, which is in the second line down. And then if you're a later retiree or you have more conservative investment objectives, we probably have you in our income model. And there are others, but these are our 3 top models for most of our clients. And so what I'm showing you here is the total growth in your portfolio for each of those models so far in this bull market. Okay. And the performance ranges from 35% in our most conservative portfolio. This is total return. This is not annualized return. Total growth so far in this bull market, 35% for our most conservative portfolio, all the way up to 48% for our most aggressive portfolio. Okay. You can also see what the performance year to date is. Okay. Year to date, every single one of our portfolio models is positive year to date. Okay. Positive returns year to date, despite what's going on in the US stock market, right? So far in this correction, if we just measure what's happened so far in this correction, yes, the portfolios are down from their all-time highs in mid-February, but they've dropped a fraction from their all-time highs compared to what we've seen in the US stock market, okay? The S&P 500 so far in this bull market up about 60%. Year to date, the S&P 500, depending on what day you're choosing to measure it on, is down about 4.5% and is off about 8.5% from its all-time highs. Okay. International stocks on the flip side, though, have had a little bit less total growth so far in this bull market, up 50%, but have maintained very positive growth year to date. Okay. Up 10, almost 11% year to date. Okay, and still up 3% while the US stock market has dropped about 8, right? So again, I think this is the beginning of a flip in the cycle, to international outperformance and to more value-oriented investments and value-oriented stocks inside the portfolio. All right. So what kind of my big takeaway predictions for you guys, all right? Despite what we're going through, okay, with that cloud, that fog around the entrepreneur, I believe by far the most likely outcome is that the fog dissipates and we continue to have economic growth. I think that with a 70% probability, okay, I think that the bull market continues through 2025. I do not think we go into a bear market recession. I don't think that's the most likely outcome. It's possible, but it's not the most likely outcome. I think over the next 2 years, you're very likely to experience kind of lower double-digit growth in your portfolio, a total return of something like 15 to 20% over the next 2 years in those portfolios, right? I think the Fed probably is going to keep rates high through the first half of this year. I do not think they're going to lower interest rates, though we're going to get a decision from them in a day on what they're going to do with interest rates right now. I think they're going to keep interest rates a little bit high because I think they're worried about a resurgence of inflation. But I do think towards the end of this year, the second half of this year, we'll see the Fed start to lower interest rates slowly. Okay. They will respond probably more aggressively if they see a spike in unemployment, but I don't think they're going to see that. Okay. So I think the rates start going down, short-term rates start going down in the second half of this year. Long-term rates, though, are another story. Okay. I do not think we're going to see drops in long-term interest rates, which include mortgage rates. I do not think we're going to see significant drops in long-term rates or mortgage rates. Okay. We have seen a little bit of movement recently. I don't think that's going to continue. And matter of fact, if we do get to the point where the Fed starts aggressively dropping short-term rates, I actually think you're going to see long-term rates spike. Okay. But again, I don't think that's actually what's going to happen. I think if the Fed decides they have to cut short-term rates aggressively, it's going to cause a long-term a spike in long-term rates. But I think it's more likely that short-term rates come down slowly and long-term rates stay pretty much where they are. Okay. I do think inflation is going to remain mostly low. I do not think we're going to see a spike in inflation. And again, I think we're going to continue to experience positive growth in GDP. I do not think we're going to have a recession. All right. Um, okay. That's sort of the end of my pre-prepared remarks. So if you do have questions, now would be the time to go ahead and unmute yourself and ask your question, and we'll dive into it. Oh man. Okay. No questions. All right. Woo. I must have nailed it.
Hey, John, can you hear me?
Yeah, I can hear you, Steve.
Okay, yeah. So in the portfolio, this growth ETF that you have,
Yes.
the percentage is still higher than the European ETF. Are you gonna get them much in line, or are you just gonna leave them like that?
Oh, great question. Thank you for asking that, Steve. Okay, so of the stock piece of everybody's portfolio, okay, so whatever portion of that pie chart is in stocks, okay, it might be for some of you, it might be 80% in stocks. For some of you, it might be 40% in stocks. Whatever slice you have in stocks, if we take that stock piece and divide it between US and international, we have maintained about a 40% international allocation. Okay, so about 60% US, 40% international. So we still have more of your money in US than we have international, which I think is appropriate because we all live here. Okay, the money that we spend is in US dollars. So I still have most of your investments here in the US. But that 40% in international, that's been that's taken a lot of guts over the past couple years to maintain that 40% international allocation because it was so relatively out of favor. So we actually debated internally, consulting with Vanguard, consulting with PIMCO, consulting with Schwab, about whether we were crazy for maintaining this international allocation that was 2 to 3 times higher than most of our peers. And the feedback we got was, no, that is the right move. It's going to pay off over the long run. And I think that is what we're seeing pay off in such a big way so far this year. And that's the only reason we've been able to maintain positive returns while, like I said, the US stock market has been dropping. Did that make sense, Steve?
Yeah, yeah. And if you overlay the two ETFs, the international and the growth, the international last 3 months have outperformed.
Yes. Yeah,
So
yeah, pretty considerably. And again, I don't know that that's going to continue forever, but I'm very suspicious that we are seeing this shift in investor preference. I mean, when most of my peers, in other professional investment advisors, institutional investment advisors, let their international allocation drop all the way to 10 to 15%, there is that leaves so much value to be had in those stocks. And so I think we're going to see throughout the rest of this year huge movements of institutional money into Europe and Asia. I think it's going to drive those stock prices even higher. Back to, I don't know if it's going to hit parity with the price to earnings ratio in the US, because I think ours is a little too high. But it's going to drive significant returns. And so we have all of you guys, I feel like, appropriately positioned to take advantage of that opportunity without being too risky, right? Our number one objective is always protect your money and then get as much growth as we safely can while protecting your money. And I think this is a very prudent way of doing that. Okay. Other questions? Oh, sorry. Yeah, go ahead,
Yeah,
Steve.
just one more. So is the emerging market and the Asian market, do you lump that into the international category?
No, they are separate. They are separate. Yeah. So we have three sort of developed country investment funds. We have one specific to Europe, one specific to Asia, and one specifically to small cap. And then separately, we have two ways of accessing emerging markets. One is through a stock fund, and another is through a separate bond fund. Okay.
Okay.
Other questions? Okay, great. Well, listen, I hope this has been valuable. I hope it's been informative. It's very important to me that you guys both understand what is going on with your portfolio, but also the why behind what is going on with your portfolio, the why behind what you're hearing in the news about what's going on in the stock market and the economy. And I want you to understand kind of what our thought process is behind the changes and the movements we make in your portfolio. Okay. We did big shifts towards small cap in the about mid last year. And again, I think that's going to be one of the shifts that really drives performance and growth throughout this year, along with that international. So again, thank you so much for being on today, guys. Please feel free to forward this recording to anybody you think would benefit from the information, who needs an understanding of how their money can be or should be managed, either in their retirement or as they approach retirement or as they're looking to make big life decisions. And as I said, my team and I are available to answer questions, to meet with your friends and family and people you think would be great for us to work with. So thanks, everybody. We'll see you again next time. Take care.